Welcome back to the channel. Today, we're breaking down the third quarter 2025 earnings from investment giant Rowe Price. The firm reported on October 31st, showing a picture of resilience in a challenging market, with solid revenue growth, but also some significant headwinds. Rowe Price Group, Inc., ticker TROW, is a premier global investment management firm renowned for providing a comprehensive array of products, including mutual funds, subadvisory services, and separate account management for individual and institutional investors, retirement plans, and financial intermediaries. The company operates with a disciplined, fundamental research-driven investment philosophy, emphasizing long-term value and in-house analysis to make informed decisions. With the history dating back to 1937, Rowe Price has built a strong reputation for its active management expertise across a wide spectrum of asset classes, such as equities, fixed income, and multi-asset strategies. The firm generates revenue primarily through investment advisory fees based on the assets under its management, serving clients worldwide from its headquarters in Baltimore, Maryland. Let's start with the headline numbers from their Q3 2025 report released October 31st. The company is massive, managing a staggering $1.77 trillion in assets. They earned $2.81 per share, and despite a tough market, they grew their revenue. Investment advisory fees climbed to $1.7 billion, helping push total adjusted revenues to $1.9 billion, a solid 6% increase year over year. But here's the number that has many investors worried: net outflows of $7.9 billion. Essentially, clients pulled more money out than they put in, mostly from U.S. stock funds. Let's look at the reasons for optimism. The bull case. First, not all outflows are created equal. While money left U.S. equities, Rowe saw positive inflows into fixed income, multi-asset, and alternative investments. This tells us they're successfully pivoting to where the investor demand is hottest. Second, their long-term track record is still elite. Over half of their funds are outperforming their peers over 3, 5, and even 10-year periods. That's a testament to the quality of their research and management. Third, they have a fortress balance sheet with over $4.3 billion in cash. This is crucial because it supports two key shareholder-friendly actions. They continue to buy back shares, $158 million this quarter, $484 million for the year, and most importantly for us, it protects that valuable dividend. Now, let's talk about the future. Rowe isn't just sitting still. They announced a strategic partnership with Goldman Sachs. This is a big deal, designed to supercharge their offerings in retirement and wealth management by combining Rowe's investment prowess with Goldman's distribution power. And they're even getting futuristic. Management confirmed they're developing expertise in digital assets and plan to launch a multi-token crypto ETF. Love it or hate it, it shows they're adapting to new trends. All right, so that's the sunny side, but we have to be balanced and look at the real risks, the bear case. The $7.9 billion in outflows can't be ignored. It highlights the intense competition in the asset management world. Furthermore, the company admitted that their institutional pipeline has weakened. This means big, future deals with pension funds and the like are slowing down. There's also fee pressure. Their effective fee rate dropped to 39.1 basis points. Investors are shifting into lower-cost strategies and ETFs, which means Rowe earns less per dollar managed. And while they're controlling costs, they still had $28 million in one-time severance expenses, a reminder that restructuring isn't free. Rowe Price is a company in transition. It's navigating a shift away from its traditional high-fee equity products towards the growth areas of fixed income, alternatives, and private credit, which, by the way, had a record year with $6 billion in commitments. The partnership with Goldman Sachs and the push into digital assets are smart, long-term bets. However, the benefits will take time to materialize. Management itself expects Q4 flows to be weaker. For a dividend investor, this creates a fascinating opportunity. The stock's decline has pushed its dividend yield higher. You're getting paid a solid income to wait for this turnaround story to play out. The strong cash position makes that dividend look very safe. Let's talk about possibilities. Attractive valuation. First and foremost, the valuation is screaming cheap. TROW trades at a PE ratio of just 11.2x. To put that in perspective, that's well below the industry average. Even more compelling, some analysts estimate its discounted cash flow fair value is around $168. That implies a potential upside of nearly 40% from current levels. For value hunters, that's a huge margin of safety. Earnings rebound and expense control. After several years of declining earnings, T. Rowe Price has shown signs of a turnaround. Over the past year, earnings grew by 4.7%, and they've managed to maintain a stellar net profit margin of 28%. How? Through disciplined expense control, targeting low single-digit growth in spending, which directly protects their profitability. Strategic growth and performance. The company isn't just sitting still, it's making smart moves, like a key partnership with Goldman Sachs and expanding into digital assets and alternative investments. This opens up new revenue streams. Furthermore, their core business is strong. Over half of their funds outperform their peers over the long term, which is a key driver for attracting and keeping investor money. But the challenges are also significant, and you can't ignore them. Net outflows and fee compression. This is the biggest headwind. The company saw a massive $7.9 billion in net outflows last quarter, mostly from U.S. equity funds. When money leaves, management fees leave with it. Compounding this problem is fee compression, the industry-wide trend to move to lower-cost investment vehicles, which squeezes their revenue even further. Dividend sustainability and pipeline softness. T. Rowe Price is known for its dividend, but these outflows and fee pressures raise serious questions about its long-term sustainability. Add to that a weaker pipeline for institutional clients, the big money, and you have a real concern about their future growth in assets under management. Performance and concentration risks. While many funds perform well, some of their opportunistic strategies have recently underperformed, which doesn't help the outflow problem. There's also a heavy reliance on the U.S. market and retirement channels. This lack of global diversification makes them more vulnerable to a U.S.-specific economic downturn.
Let's look at the consensus. When we aggregate the ratings from nearly 20 major analyst firms, the picture for T. Rowe Price is murky. The overall consensus rating is a hold or even a reduce, and that's not the most confident vote you'll see. Breaking it down further, you have about 10 analysts saying hold, another 4 are outright recommending sell, and only a minority of 2 are on the buy side. So right off the bat, the sentiment is mixed to cautious. But what about price targets? The consensus price target sits right around $105 to $106 per share. Now here's the kicker. As we're recording this, the stock is trading at almost exactly that price. This implies that the collective wisdom of the market sees minimal, near zero upside for T. Rowe in the near term. It's what analysts call fairly valued at best. Pessimistic view is perfectly captured by Goldman Sachs, which has an $80 price target and a sell rating on the stock. That's a significant potential downside from current levels. All right, so where does this leave us as dividend investors? T. Rowe is trading low and paying a dividend which automatically boosts the yield for new buyers. That's the opportunity. But the key question is the dividend safe? The analyst consensus suggests that while there isn't a major panic about a cut, the risks are real. Those ongoing outflows and fee pressures are headwinds that could challenge future dividend growth, even if the current payout seems sustainable. What's your take? Are you considering adding T. Rowe to your income portfolio at these levels? Or are the analyst concerns too great? Let us know in the comments below. Thanks for watching, and we'll see you in the next video.